Hey guys, welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio. And today we're going to be kind of talking about some recent action that's kind of been happening inside of Fabio's portfolio. I'm going to be asking questions about this specific action that's taken place that has to do with Orion. So without further ado, let's jump right into this. What are we looking at here today? And the first question for today is, what is this and what happened?
So what is this to begin with? So basically this company is called Orion Office Realty, and it's a spinoff of one of my core positions. It's been a core position for a while now, and it's Realty Income Delaware. This is a REIT held in a tax advantage account, so I won't pay any taxes on those dividends, but that's not this kind of video. So I also got shares of this company, Orion Realty, and one thing that I've decided to do is continue to hold the position and actually potentially add to this position. So I'll be frank right off the bat, there's not going to be a lot of financial data. There's just a lot of, some rough math estimations on the FFO numbers. And then we'll kind of talk about that as to what's going to be the payout ratio and the dividends, et cetera. Because as a REIT, it has to elect to pay a dividend because it's a pass-through entity. A pass-through entity simply means it will not pay taxes. The taxes are passed the burden on to the, I said I wouldn't get into this. I'm getting into it.
It's fine. Just like a little bit. Yeah.
The taxes will be passed on to the investor, and being in a tax advantage account, it's not passed on to me. So no one pays the tax. Now, that being said, what are we looking at in terms of the business model? This business is primarily focused on suburban office space. And if you're thinking about that, you're like, okay, office space, work from home, how does that fit? Well, I think that going forward, there's going to be a huge shift away from office space, but particularly in the urban environment. So I was explaining to you, Austin, first of all, a lot of the clientele for Orion is, the largest tenant is actually government, funnily enough. And yeah, that's the best tenant. Well, no, there's a drawback to government real estate. So government real estate typically will sign long lease agreements, but with very small rental increases. But the long lease agreements adds to reliability of the rental income. And it's the government who as we did a little bit of a video about macroeconomics. Depending on what macroeconomic theory you subscribe to, can borrow technically infinitely. So it's one of the best tenants you can have. Or if you subscribe to other theories, you can't borrow infinitely, but at least it can tax the tax base. So with that being said, we have some government agencies that are the largest clients, and we have other like medical clients. So Austin, when we had our conversation, you said, well, medical offices won't go out because nurses still got to go to their job regarding, maybe dentistry. You still got to go to the dentist physically to actually get your teeth cleaned. You can't do that virtually. So stuff like that. So that's a lot of the suburban office space that we're talking about. They're going to be focusing on single tenant office space. So the reason why that is the parent company. One of the reasons why I own Realty Income is it's a triple net lease REIT. And triple net lease simply means that they don't take care of anything of the property. All that liability falls on the tenant. So the headache doesn't fall on the actual REIT. And that's beneficial because it alleviates the company from a lot of the overhead costs. And you can see that the employee base, based on the size of the business, is really small. So if you actually look at, for example, Realty Income, the employee count, it's going to be very tiny compared to other companies of the size of about $40 billion, because that's the market cap of Realty Income. And you'd be like, wow, they have so little employees. Well, it makes sense when you think about it, that it's a triple net lease company and there's none of that overhead. So the taxes, the property taxes, is all paid by the tenant. The maintenance of the property is paid by the tenant. Everything that Realty Income focuses on is the rent collection. So Orion Realty Group will do the same thing, however, with commercial, not commercial, but suburban office space. So why am I interested? Well, I'm interested because, one, we are seeing some price action here, and I want to highlight how careful we're going to have to be with this company. It's not all roses. You have to be extremely careful with this because everyone's just getting their shares, right? And you can see this big drop here from the initial IPO of 25 all the way down to 17.64. Blood is running on the streets. But why? Remember, I always repeat this, mechanically, how stocks go up and down is more sellers and buyers, more buyers than sellers. So here, what you can presume to be happening is the people who got the new shares, a lot of them are just selling it. They just start selling because they don't want this company. They're like, why is this in my portfolio? I just want realty income. So they were probably selling this company and then buying up more realty income because they didn't want anything to do with this. And then a lot of the thesis behind not wanting anything to do with this is if realty income didn't want anything to do with this, why should I? And this came off of the backs of an acquisition that Realty Income did with a company called VREIT. So they combined the two REITs together and then they spun off the office section because they were like, oh, we don't want to deal with the office section. Now, is it true that we're going to have office Armageddon? Maybe. Okay. Now, what is the problem with some of this thesis? Well, it clumps the entire office sector into one. And I think you have to separate suburban and urban. I think urban may have a huge hit going forward because urban gives you the advantage of clusterization or density. So if I need to go to my urban office, right, the benefit of the urban office is concentration of talent, concentration of customers within the vicinity, because if I need to go visit them or they need to visit me, they're there, everyone's close by. But in the suburban office environment, you don't have that advantage because, you have to drive to the person. But a lot of employees, right, the majority of the middle class live where?
In suburbia.
In suburbia,
which
right?
Kind of exactly, you're already kind of answering some of the questions that I had.
Please ask some more so we structure.
Yes, I have many questions. I've been taking notes here, but so basically my first question, and you're already sort of explored this a little bit. Do you think there's going to be a significant push towards more of a suburban type of office space, as we're now coining it now? And then also, what might be some of the advantages of this specific entity itself focusing on single tenant office spaces? And then third, this is just kind of a technical thing with getting into the technicalities of the way that REIT accounting works itself. What is FFO and then AFFO? If you might just want to give a quick recap of that for maybe some of our newer audience out there who might not know.
All right, I'll answer those backwards. So FFO, AFFO is funds from operation, adjusted funds for operation. In simplest terms, to be quick about it, it's cash flows. It's the actual cash flows of the REIT. Adjusted funds from operations is the one I tend to use because I think it's a little bit more accurate. But you could use either or. You just have to be aware of what each one is kind of different. But for the most part, they're more or less the same. REIT investors will use one or the other or both sometimes. And it can be dependent on the REIT, right? In which case, which one you would want to use. But for the most part, you won't do too terribly wrong with going for one or the other. We want to use AFFO and FFO instead of GAAP net income because GAAP net income is not going to accurately reflect the actual operations of the business because there's going to be a heavy depreciation cost and along with a bunch of other things. And with the law says that GAAP, they have to pay 90% of their GAAP net income. So actually that's the benefit. If their AFFO or FFO is higher than their GAAP net income, they're actually going to be retaining a lot more of their cash flows than meets the eye. Because you might be saying 90% payout ratio, that's terrible. They have no money to retain and then reinvest and buy new properties. No, you're not thinking of it properly. You're thinking of it with GAAP net income in mind, thinking that GAAP net income is this holy grail of accuracy. It's accurate for what it's trying to measure. I'm not saying that it's not accurate for what it's trying to measure, but it's not actually reflective of maybe the true nature of a business's operations, depending on what you're talking about. So with REITs, it's not at all, and you don't want to be using that. However, the law is reflected on the GAAP net income. So they had to pay out 90% of the GAAP net income, not the actual cash flows coming in.
So now, I've actually seen a significant bear thesis just in regards to REITs as a whole. And they say actually exactly that, because they have to pay out 90% of their GAAP income. Therefore, you should avoid REITs because you're never going to get a return from your investment inside of REITs.
Okay, but so here's to dispel that. So exactly. Did you know that the REITs index, that's what I was about to ask. The REITs index has outperformed the stock index for like its entire existence.
Yeah, well, I did know that, but okay. Also, just just in case maybe some of our newer audience hadn't have known that, that's really kind of a central point of like what you're trying to say here now. And now here's my other question too, before I ask you those other two questions in regards to this specific entity itself. Is there typically like an indicator or a comparison or a story that you can derive out of the numbers in regards to a REIT that focuses on triple net leases inside of AFFO or FFO numbers within these REITs themselves?
Actually,
Like
you'd
basically,
get the triple
yeah.
net. You'd see it in the gross income,
Okay.
because
Cool.
it's or not even that. I think income from operations on the actual income statement. So going back to the GAAP numbers, you'll actually see it because the operational expenses are very low. They're like nothing. You would see that there, and then you'd see something. Okay, so I'll point out one that's not a triple net lease. So any of the apartment tenant REITs, they're managing all these tenants, right? So they need a lot of employees. So think of like Essex Property Trust. I think the ticker symbol is ESS. And they are a apartment style operator. So they operate big apartment buildings. So they need to keep track of all these tenants paying rent, et cetera. That requires a larger operation than something like Realty Income that has, all these single tenant properties, and the tenant is taking care of the property. They don't have to even deal with that. Well, Essex can't do that. And you'll see that if you compare the two numbers, you'll see what I mean. But with going back to Orion, what was the you asked three questions. I forgot the first two because we went on.
Yeah. So one of the other ones is what are some of the advantages of focusing on single tenant office spaces?
Oh, okay. So,
and then the other question after that one was, do you think that there's going to be a significant push towards a suburban
they're kind of
space
connected
environment?
So
yeah,
benefits of single tenant. I'll go with single tenant because the suburban part I'll answer in the second one. But the single tenant one is it allows you to do a triple net lease. If you do multiple leases all at once, all of a sudden it gets a little more convoluted and a little more questionable about triple net leasability, because single tenant is very easy to do triple net lease. Because if you don't do that, right, you have one property, right? You have one property, and the property will have a tax bill, a property tax bill at the end of the day. And if you have multiple tenants in it, how are you going to tell all the tenants simultaneously? All of you are responsible for the tax bill of the property. It gets a little more complicated. You see, it's simpler when it's one tenant in one building, one property tax, done. Okay, that's the advantage. If you have many tenants, imagine a skyscraper, and you tried to do, and you have released out all the office space, and you're like, all of you are responsible for the tax bill of this whole building. Good luck with the administrative costs. Like, how are you going to administer that? Possible, perhaps. Comfortable? No, it's not comfortable. It's not ideal. It's ideal in a single tenant property style. So that's the advantage. The suburban side is, well, what I said, going back to the city example, the suburban advantage is, one, it's going to be generally maybe closer to your employees. A lot of them have families, perhaps. And as well as the technology has enabled people in the suburbs to do their job equally as well. But the office environment still serves a purpose, right? Not only is suburban cheaper per square foot than urban, but it also can still serve the purpose of collectivizing people in a group that allows them to enable the creativity. It's like when you and I talk over Zoom versus you and I talking in person. That feeling, that difference in spark that occurs in our conversations is what a working environment is ideal for. So you want to incentivize that to continue. And one of the ways to do that is kind of like a hybrid model, which is seeming like what we're going for. But the hybrid model does not entail you to need to go to the urban environments as much, and where you have to pay a ton of money for very little office space. You can just go just as easily to the suburbs and be closer to home, typically, if you have a family. And a lot of employees have families, right? So then you want to incentivize, hey, our office is close to, homes where you can live. And if you want to come to the office for whatever reason, we have like maybe, I don't know, something work that day that you want to work in teams, or you're having trouble with something and something better to be solved in person, then you can go. And that's, I think, where the world is moving. It's not moving to only online, but it's not moving back to the way things were. It's going to be more hybridized. And I think the suburban office environment is going to be highly advantaged of that, because in the past, suburban office environments were kind of the stepchild of the office space, and the urban office environment was like the luxury. You wanted to own those assets. You couldn't go wrong. You owned the office space in New York City. You just, the price only go up. You know, that's the sentiment you had. And you could always increase those rents because there's always demand for your, and that may continue. I don't know. I'm not making a claim here, but I do think I'm making this claim. I do think suburban office space will be more attractive going forward. Not to like say we're going back to an office only or office primary. It's going to still serve that hybridized environment where, again, if I'm working a job that it requires creative intelligence, it does help a lot to see other individuals and talk to them in person. Sometimes people's homes, I've talked to you how, like, you know, some people, of course, they have nice homes where you can come and they have, you know, the grills, et cetera, outside, big outside space, places for people to talk and stuff. Some people don't have that. They don't want to mix the home and work together. So it's best to have a place to do that, right? A place for everyone to just gather and be professional, et cetera. So that is still going to have a necessity. And again, we're talking about two vastly different worlds in terms of rents. The urban environment is a lot more expensive than the suburban environment in terms of these rents. So I think that answered the advantages.
It did. And then I also have another question, and this really actually has something to do more so with apartment REITs. And kind of my question to you, and just as like a basic overview before we wrap up this quick episode today, is what are some things that you look for specifically in apartment REITs? Like, what are some good green flags that when you're analyzing an apartment REIT, you are specifically looking for?
Okay. Yeah. So you want to see all REITs are going to be diluting you. Okay. So you want to see that the one, I'll come back to why that's important. One, they're investing and building or acquiring in areas that you personally also agree with, right? So that's kind of like a first smell test. You may like think, okay, Florida, Texas, booming economies, growing economies, fast growing economies. I want to see, and okay, spoiler, I believe that. So like, I believe that based on the numbers and everything. So I would look for REITs that are focusing in those two regions. And I think that those will do well over time, for example. And I know that, for example, I think one of them is, I won't shout any more names. We'll do just separate videos on them. But you want to see that there are REITs, those REITs are investing in those areas. And then you want to see, back to the dilution, why that's important. You want to see that AFFO is growing faster than the dilution. Because what does that mean? That means they're acquiring properties accretively to the dilution, because the dilution comes with the price tag. The dilution comes with that dividend, right? So the dividend yield, let's say the dividend yield is 2%, right? They have to acquire, ideally, properties. If they're going to dilute, let's say they create one share, and that one share is 2%. The one share buys one property. Okay, it'd be hypothetical. Okay, I know that one share can't buy one property, depending on the price tag of that share. Hypothetically, just to keep things simple, 1-to-1, one share costs 2%. One property, you want the rental rate, the cap rate of that property to be greater than 2%. Okay, and then if it's greater than 2%, what does that mean? That's accretive. Right, so that's what you want to pay attention to. So how you measure that is AFFO is growing faster than share dilution. All right, then that's another thing you want to watch out for. That's for all REITs, basically. By the way, that's not just actually apartment REITs. The apartment REITs, basically, the primary is the first thing, but for all REITs, you want to pay attention to that. So you want to make sure, okay, are they investing in areas that I think are long-term? There's long-term tailwinds, and remember, everything kind of coincides with that. So you can growing economy will actually grow the customer base of the REIT, and the customer base is the rental market. And typically, you'll have the apartment REITs focus in more urban, quasi-suburban environments. There are rental REITs that own single-family homes. There's REITs for everything. I love the REIT sector. It's not together. They don't make more than 20% of my portfolio, but you know, I do like some names. There are some names that have been with me for a while now.
Yeah, well, I mean, like, this is especially interesting for me, just hearing and learning about this too, which is why I'm asking you so many questions today. Like this is actually like legitimate and live. Like I'm actually incredibly interested in what
Well,
I'm
we can
hearing.
do more videos on REITs. And I think if you have any requests on some REITs, this is a REIT video. So go ahead and comment them down below. We've talked about some REITs in the past. But yeah, go ahead.
Also, if you want me to post my notes that I've been taking too on some of the stuff Fabio's been saying, as well as some other questions, let me know in the comments below if that might be helpful to you guys as well. So any closing thoughts, Fabio?
Oh, that's pretty much it.
All right. Well, you've heard it here, folks. We're your hosts, Austin and Fabio. This is the Capital Mindset Show. If you like what you've seen today, please be sure to share the video. It really helps out the channel. Please be sure to visit our website at capitalmindset.org and like, comment, and subscribe. And we'll see you later. Take care.